Hey there, welcome back to another episode of Bald Prairie Real Estate. My name is Matthew Pfeiffer, and I want to educate you all about real estate. If you've been keeping track of the news recently, you're probably seeing a ton of articles about how negatively rising interest rates are going to impact the Canadian real estate market. I saw an article just the other day about how it's going to cause house prices in Canada to decline by 20%. Is that really what's going to happen when interest rates go up? Well, we see the Canadian housing market see that much of a decline. That's what I want to get to the bottom of in this video. After this video, if those rising interest rates don't discourage you from wanting to buy a house in Canada and you want to get set up with the best real estate agent in your market, I've got you covered. You're going to see a link to my calendar in the description of this video. You can book me in for an appointment. I'm going to give you a call, learn about what's important to you, and then get you set up with that perfect agent. But before we get into this video, let's start off like we always do with another terrible joke. Where do math teachers go on vacation? Times Square. If you have a terrible joke that I can use in a future episode of Bald Prairie Real Estate, put it in the comments below. Give this video a like. The YouTube algorithm really likes it when you do. And if you haven't subscribed, hit the button right there and subscribe. When interest rates do start to rise, how much will that impact those that currently own a house today? Well, first off, those on variable rate mortgages, they're going to see the impact immediately. Bank of Canada raises the rate, pretty much the very next day, those homeowners are going to be paying more on their monthly mortgage payments. But what about those on fixed payments? Well, they're not going to see this change until a couple of years down the road when they have to go renew their mortgage. I'm going to talk about them a little bit later in this video because I think that's an interesting set of homeowners to keep an eye on. But why don't we go through an example with an average price house in Canada right now that's about $750,000 and see how much of an impact rising interest rates will have on that homeowner. In this example here, we're going to look at an average price house, which is $750,000. This buyer has $50,000 as a down payment and their mortgage rate was 2.5%. That means their monthly mortgage payment is about $3,200 a month. Let's change that though. Let's go up here, make this 2.75 and see what happens. As you can see now, we go up to a little over $3,350. So each quarter point works out to about a $100 bump in this person's payment. How much rates are going to go up in the near future? Well, that's just about anyone's guess. I've seen predictions as low as 1 or 2 and as high as 7 or 8. So in this scenario, you're talking about a $200 to $800 bump per month in somebody's mortgage payment. A $200 payment, probably not going to have much of an impact on somebody. An $800 a month payment, yeah, I think a lot of homeowners will start to feel the pinch of $800 more per month on their mortgage payment. If the Bank of Canada does raise those rates 8 times this year, that means it's likely going to go up 2% because usually they raise interest rates a quarter point at a time. Do you know when the last time that interest rates went up 2% in 1 year? 1998. So it's been a very long time since we've seen rates go up that quickly. In 05 and 06, over about 18 months, so a year and a half, we saw interest rates go up a little shy of 2%. And then as well in 17 and 18, again over about an 18-month span, we saw interest rates go up again by about 2%. So seeing that happen over a year and a half or 2 years, that is far more common in 1 year. That hasn't happened in a very long time. So seeing interest rates go up 2% over the course of the next 2 to 3 years, that wouldn't surprise me at all. Seeing it go up 2% in 1 year, that would be pretty shocking to me. How much will these rising interest rates impact those looking to buy a house right now? Well, let's pull out a mortgage calculator and see how much these rising interest rates will change what a buyer is qualified to spend. Hey, in this example, let's take the average household income in Canada, which is $110,000, and this buyer has a $50,000 down payment. They're going to pay 2.5% for this interest rate. That's a pretty common fixed rate right now. They're buying in Ontario, and we're going to say for this example, they've got no debts. Well, what are they qualified to spend? $750,000, which is exactly what the average house price is in Canada. Okay, I set that one up on purpose. But let's say interest rates, well, they go up to 3.5%. They're still qualified to spend $750,000. Well, what if they went up 3%? So they're going to go up to 5.5%. Now their affordability changed. But why did their maximum qualification not change when interest rates went up 1%? It wasn't until interest rates went up 3%. So why didn't what that buyer was qualified to spend change until after interest rates went above 5.5%? That's because since 2018, we've had the stress test in Canada. That means anybody who's looking to buy a house in Canada has to qualify under the stress tested rate, which used to be the average of the big 5 banks posted rates plus to about 2% typically. So it hovered around 5% since last year. The government has taken that stress test rate over and now they decide what it's going to be. It's currently 5.25%. So unless the stress test increases, what a buyer is qualified to spend will not change regardless of what happens with interest rates. But it will change how much per month that buyer is going to have to spend to buy a house. So you may see buyers choose not to buy because of that. What we are seeing though right now is buyers rushing to the market to get in before those rates increase. And that's part of what's causing the big spike in demand we've got right now. But anyone who is in the market right now because they are needing to buy a house, instead of pulling out of the market because they still need to buy something, they're just going to change what their budget is. So if they're planning on spending $450,000, interest rates go up, they may choose to instead only spend $400,000. Basically, they just drop down to a different price category. The demand is still there, it's just in a different price point. Real estate investors are probably a segment of the market that is going to feel and react the most to these rising interest rates. Because when somebody buys an investment property, more often than not, they want what is called a positive cash flow. That means that what it costs them to maintain and own that property, they want the rent to exceed that number. Let's go through a little example and explain how that works. For this example, let's say it costs the owner $500 a month and they're going to rent it out for $700 a month, meaning they've got a $200 a month positive cash flow. Then when interest rates go up, all of a sudden now maybe it costs the owner $700 a month to keep the property. That would mean they have a $0 cash flow, probably not something that they're looking for. So they're now going to have to raise the rent in order to still have that positive cash flow, because not many landlords are going to want to have a negative or $0 cash flow. They're going to want to continue to have a positive cash flow. So that's one of the reasons you will probably see rents go up as interest rates go up. When interest rates go up, if the rents do not also go up, that means that investor may be in a position where it no longer cash flows, or if they're looking at buying a property and they see that it is not going to be cash flow positive, they may choose to either sell the existing property they have that no longer cash flows, or not buy a property because it doesn't have positive cash flow. So these higher interest costs are one of the reasons I think the investor market is going to be impacted the most. As well, those investors that are expecting that the property is going to increase in value year over year by some pretty exceptional numbers like it has recently, if that is no longer happening, they may choose not to buy those properties. Will rising interest rates decrease demand? Yes, it will. As rates go up, we will see less buyer demand. But for it to make a meaningful impact, we're probably going to have to see rates go up 1 or 2% in a fairly short period of time. By that, I mean within 1 year. If we only see a half point or maybe even 3/4 of a point bump in interest rates, that's probably going to have very little impact on the market. As we've seen, it doesn't change how much a buyer is qualified to spend. It just increases their monthly payments. But as well, most buyers, pretty much all buyers out there right now, are going to have rate holds for 90 days. So if rates go up tomorrow, those buyers still have 90 days to purchase a home on those lower rates. So it's going to be kind of a little while before we see the true impact of rising rates. There's going to be a delay between when rates go up and when we see it in the sales numbers. What ends up having a larger impact on the market is fear. The fear that the market may decline or that rates are going to keep going up forever will cause more buyers to pull back from the market than the actual rising interest rates themselves will. As we've seen in past times when interest rates have gone up, we typically see a 10 to 15% decline in the number of homes sold, but that's usually very short-lived. Within 24 months, most buyers have gotten used to these higher interest rates and return to the market, and often we see sales pick back up to where they were before the interest rates were increasing and sometimes even surpass where they were. What will happen to house prices then? Well, we're not going to see much of a change if we continue to see this strong demand, But if we see interest rates rise, we typically see the demand drop as well. We would need to get to the point where there's more sellers than buyers to have any meaningful impact on prices and put downward pressure on prices. And if past history has anything to say about buyer demand, that it typically drops only for about 24 months and then returns to the same levels it was and even higher than before. So if we see a drop in prices, it's likely going to be very short-lived. What's going to happen to those on fixed rate mortgages? And remember, still today, the vast majority of Canadians have fixed rate mortgages. There was a time in 2001 that you could get a fixed rate mortgage for like 1.5%. Fantastic 5-year fixed rate. So what's going to happen then when they go to renew their mortgage in 3, 4, or 5 years? That's going to be really interesting because they're going to see a big jump in what their payments are going to be if rates do end up being 2 or 3% higher. Those on variable rates have kind of gotten used to those higher payments over the last couple of years, but those on fixed rates are going to see a big jump, and that's going to probably have a shock to the system. Will we all of a sudden see a big surge in foreclosures happening because all those on fixed rate mortgages all of a sudden can't pay their mortgages? I don't think that's what's going to happen. They've already been stress tested paying at least a 2% higher interest rate, and so they should be able to withstand those higher payments. But let's just say they are in financial trouble and they do have to sell the house because they can no longer keep making the payments. They're not going to turn it back to the bank. They're going to put it up on the market for sale. And with how much prices have gone up just in the last year, let alone what's going to happen the next couple of years, they're likely going to be able to just sell that house and walk away with a pretty sizable amount of money. So we may see the number of homes for sale increase in a couple of years as those on those fixed rate payments decide they no longer want to continue making that mortgage payment at those higher rates. But I don't think it's going to be a massive surge of houses coming up for sale, and probably not a big surge of foreclosure listings. Rising interest rates will increase the monthly cost for current homeowners, and those looking to purchase will also see the cost of ownership go up. So that may and probably will reduce demand. All this really strong buyer demand we've got, we'll probably see less of that, and less demand should mean inventory increases. When inventory increases, we may get to the point where we have more supply, and thus the pace of price appreciation doesn't continue to skyrocket up like it is right now, and that could result even in potentially prices dropping a little bit. But if history has anything to say about it, that drop in both sales and prices will likely be short-lived. Within 2 years, most homeowners and home buyers will have gotten used to those higher rates, and we typically see that the sales come back as well as prices back to the levels they were before, and maybe even a little bit higher. But you know it won't be short-lived. This awesome Canadian real estate market update, giving you all the information you need to know about what's going on currently in the Canadian housing market. And this video right here is what the YouTube algorithm says you need to watch next on Bald Prairie Real Estate. As always, thanks very much for watching.